The gold market really started to unleash in 1971. And did you know that Mother Earth only had about 3 billion people on it? And today, it has over 6.5 billion people. And back then, China and India, Chindia as is well known today, were basically non-events. Economically, they had no global footprint. But today, they are significant. So this natural affinity for gold as jewelry, and now gold as a monetary asset, and having the significance of their contribution to the world, gold has a very interesting super cycle to it. Now let me walk you through my visuals to help you understand the drivers of this super cycle in gold. What's driving gold? The critical drivers for gold are pointing in the same direction. And what's important is to recognize this matrix that we have created. There are 6 factors, and sometimes 1 or 2 are driving the price of gold. The big moves with gold are when all 6 factors are aligned. And when they're not aligned, we get these corrections. Over the past 4 decades, September has been the best time for gold in terms of its month-over-month price appreciation, as you can see from the chart. September kicks off several key factors for gold demand. First is the season for Ramadan. It's a holy season. And then we have the Diwali season, the season of lights in India. And then we have restocking for jewelry makers in Christmas, and then the Chinese New Year. China, the world's 2nd largest gold market, actually saw a year-over-year gold demand increase of 6% in the latest quarter. The World Gold Council says buyers are favoring 24-karat gold jewelry for its quality and store of value, and the trend should continue. Even though India was declined, China remains robust and vigorous. September is also an excellent month for gold stocks. The chart shows that the GDM Gold Miners Index, after soft months in June and July, the miners on average gain 2% on a month-over-month. In fact, you know what? They can jump 8% in the month of September. And that's really what we're witnessing today. The strong correlation between the gold price and the value of gold mining stocks explains much of the average September jump for gold stocks. But the relationship is not just lockstep unhedged gold stocks in particular have historically offered the best leverage. There are other factors in addition to these fundamental jewelry demand drivers. We also have a currency factor. One of the most consistent correlations for gold is the inverse relationship with the US dollar. The chart shows that September is, besides December, in dollar terms, is the weakest time. The DXY, trade weighted dollar index, on average drops 66 basis points from August. So it's important for investors to recognize not only do you have this demand picking up for jewelry demand from China and from Asia as a whole, and India in particular, we also have the dollar. So all of a sudden gold has this dual capacity as for jewelry demand and as a currency. Now this is another great visual that I love showing, and it just shows you this pattern of a year-over-year basis, and it goes back many, many years and looks at different periods, but basically you can see that the demand for gold starts to accelerate from July and August lows and runs up in September. It's important that we, as investors, that you appreciate that a lot of the noise and the hype that all comes in September could be a late time to be looking at, to be buying gold, and it's best to be waiting for these corrections. Now, how do we do that? What we've noticed are these oscillators, which we've commented several times on our investor alert and our educational pieces called Anticipate Before You Participate, understanding volatility. And what this is showing you is the volatility rolling over 60 days. And anytime the gold spikes more than 2 standard deviations and we have lots of money rolling into our funds, we do not like to invest. We're looking for that correction. And whenever gold falls 2 standard deviations, this is when we get the redemptions, and this is usually the best time to be looking to be buying gold and gold stocks. Now this is looking at the inverse correlation of gold to the dollar. Now, why is this important in a sort of a thought process of understanding volatility? Well, I mentioned to you earlier that there's a strong 70 to 80% of the time the dollar is inverted related to gold. And what we're seeing here is gold is strong and the dollar is weak. And when that spread gets quite wide, the mean reversion, that power of pulling back together, is quite significant. If you use a histogram, you can count this. You can't do this in Vegas, but you can count the probability of a correction. And these are key factors that we look at of trying to make market decisions. This chart compares the total return performance of the S&P 500 with that of the Toronto Gold and Precious Mineral Index going back to 1971. It was in August of 1971 when gold was basically unleashed and became free trading. And at that time, the United States was fighting in Vietnam and pumping billions of dollars into the finance system to pay for it. The dollar's value dropped and the demand for gold shot up. At the same time, the U.S. stock market was suffering, taxes were high, and new regulatory entities like the EPA were being created. I love history. I like going back and see if I can see patterns that can help me make better decisions. So let's take a look at the S&P 500 at the start of 1971. And what you can see here is that it underperformed a gold stock index for a quarter of a century. Basically, investing $10,000 in 1971 in the TSC Gold Index or the S&P 500, one would have made $40,000 more in gold stocks during this period. This chart shows the U.S. government surplus and deficits going back to 1971. When the federal government is deficit spending, gold stocks tend to outperform the broader market. The S&P 500 didn't outperform gold stocks until 1997 during budget surpluses under President Clinton. When those surpluses turned into huge deficits after the September 11th attacks, the spread between the broad market and gold equities narrowed. I think what's also important for investors to recognize is interest rates. What is a positive or a negative interest rate? And what I mean by that is, what are you earning on your treasury bills after inflation? And what we have found is that whenever their interest rates are negative, then gold starts to perform in that currency. And whenever the interest rates are positive, that is, if we're making 4% on our treasury bills and inflation is running at 2%, we have a 2% positive rate of return. That currency is strong relative to the price of gold. Now, when you add negative returns on treasury bills coupled with deficit spending, gold starts to move. At the same time, in this visual, I want to point out that China began to deregulate its precious metals markets. And the White House projected a $1.6 trillion deficit this year and another $9 trillion between 2010 and 2019. So this deficit spending, along right now with the concerns of deflation, with negative interest rates, just bodes extremely well for having exposure to gold as an asset class. Now let's look at stock picking, the bottoms-up approach. What do we focus on? We have found in our studies that there are three value drivers: growth in production, growth in cash flow, and growth in reserves. And then we like to look at the stocks that have the most attractive relative valuations, and we like to look for those that have this momentum. And those stocks in that sweet spot that have momentum in their production and momentum in their cash flow and reserve growth far outperform their peers. Now, except for one important factor here, and that is hedged versus unhedged. Unhedged gold stocks that have momentum in its production, cash flow, and reserve growth have far outperformed its peers. A classic would be Anglo Gold in South Africa versus Rand Gold. Anglo Gold has had a huge hedge book and has far underperformed Rand Gold. Further to that, the CEO of Rand Gold has been extremely conscientious of protecting, without financings, the dilution of its production per share and its cash flow per share. So any transaction or event that's taken place has always been extremely accretive. So these are the things that we like to focus on in looking at those gold stocks.